think one of the biggest, we'll call maybe the group that's probably going to be the most disappointed is team status quo, right? Folks that have gotten used to back 20 plus years in the markets who are just expecting we're going to have the same performance in the markets again this year. I think it's going to be much harder for financial assets to continue rising at the pace that they've been rising at. And analogize this to make an American analogy. If your team wins the Super Bowl, you're thrilled. If they win it again the next year, you're ecstatic, but now you're thinking dynasty. So you're coming into that third year with the expectation that your team's going to win the Super Bowl again, right? Which is statistically highly unlikely. So anything pretty much that team, any performance the team has that year short of winning the Super Bowl is going to disappoint you. I don't know if the markets are actually going to end down in 2025, but I feel fairly confident predicting that we're not going to see another 20+% year. We'll probably see something more on the lines of the single digits. And to a lot of people, that's going to feel really disappointing because they've gotten so conditioned to these, recent great years that we've had. And of course, there's potential there for much worse performance in the markets as well. And if we do that, then people are really going to be unhappy. I also think there's going to be a lot of dismantling done by the status quo by the incoming Trump administration. And I don't think that's a huge surprise to anybody. And there have been a lot of things that many people that I interviewed have expected to break that haven't yet. I think 2025 may be the year that happens. For example, we had the Fed and many other central banks around the world hike interest rates more aggressively than they had in living memory. The lag effect of that has been expected by many people, myself included. Many people have come to the point that it's not going to arrive because it hasn't yet. We're seeing it's getting harder for the Fed to continue cutting here. So the pace of rate cuts may be a lot slower than the market initially expected. Bond yields have gone up even while the Fed's been cutting. So it doesn't really matter. Higher for longer doesn't matter so much on the short end of the curve that the Fed controls. It matters on the long end of the curve, which the Fed does not control. And the longer we're at higher for longer with longer dated yields, the more gravitational effect that's going to have on the economy. And we're going to start seeing GDP slowing. We're going to start seeing things like the unemployment market, which has really been the big bulwark between the economy and recession. If that starts cracking this year, that could really be a game changer again in a way that's not going to be fun for team status quo. We're already beginning to see it here in the US, right? Where the Fed would love to do its regular playbook and cut rates aggressively again from here, but inflation is just proving stubbornly sticky. So I think that once the inflation genie's out of the bottle, it really diminishes central banks' prospects. And unless a big recession arrives, which will get inflation under control, but not in a way that folks are happy about, and then the central banks will probably return to their super stimulating playbook, potentially making inflation worse in the long run. I do think it's going to be harder for the central banks to go back to the golden era that they've had over the past couple of decades. I think the key thing to note is we hear about the Federal Reserve, which is America's central bank, and that basically sets the price of money, and it does that by monkeying around with its policy rate. But that really only affects the debt that the US government issues on the short end of the curve, meaning like really short-term debt, like debt that's exists for weeks or months, maybe a year. When borrowing goes on around the world, yes, the US government borrows all along the curve, but a lot of its debt is further out on that curve, and that gets impacted by foreigners' willingness to buy or not want to buy the debt. But also importantly, corporate America doesn't borrow based upon the federal funds rate. It borrows basically on rates that are set more or less off of the 10-year US Treasuries. That's the foundational benchmark that corporate America uses. As the Fed started hiking interest rates, understandably and practically, corporate America said, okay, it looks like debt's going to start getting more expensive. Let me start taking on as much debt as I can right now while the cost of debt is low. It's stocked up on debt coming out of the COVID era, right as the Fed started hiking rates. And so the debt that's been on corporate America's balance sheet has been relatively low the past couple of years. Even though interest rates have gone a lot higher, corporate America hasn't had to refinance. It's just been sitting on that debt that it took out at low interest rates. Now a lot of that debt, an increasing amount, is coming up for maturity, coming up for renewal. And therefore the companies have to go back and say, okay, that loan I had is now expiring. I got to take out a new loan. And in many cases, the cost of that new debt is like twice than what the company had on its balance sheet. And the future of the economy is basically based on the future of corporate earnings. And all else being equal, if the cost of your debt on your corporate balance sheet goes up, then your interest expense on your income statement goes up and your earnings shrink. And so as corporate earnings shrink, GDP starts shrinking. That begins to be the progression with which you could go into recession. So that's why this is so important. right now we have this dynamic where everybody is in the same pool. If you look at on an earnings basis, almost all the earnings growth in the S&P is in the Magnificent Seven stocks. Similarly, the concentration of market capitalization, its percent of the S&P 500, is the largest it's ever been in the smallest number of stocks. Again, these sort of Magnificent Seven. Now, if you look at the US's share of global market cap, it's the highest it's ever been. Right. So the entire world has basically come to the US market because this is where the best party is right now. The entire US market is pretty much all in stocks, and that stock market is pretty much concentrated in just a very few amount of stocks. When you look at retail participation in the stock market, it's about the highest it's ever been. When you look at the percentage of stock exposure that senior citizens in America have, it's about the highest it's ever been. So basically everybody is pinning their prospects on 7 to 10 stocks when you really look at it this way. When you look at the explosion of ETFs that's happened over the past decade, the concentration of ownership amongst those ETFs is the highest it's ever been in the smallest number of stocks. And again, they're all these same 7 to 10 stocks that we're talking about here. The point I just want to underscore here is that if something goes wrong with 7 to 10 stocks, it's going to take absolutely everything down with it. And I'm not sure the world really understands how much of its prospects are revolving around so very few. And valuations right now are about as stretched as we've ever seen. Cyclically adjusted PE ratios are at a 38% multiple. It's only been that high, I think, once or twice before. I think it was right before the 2008 crisis, but it might be .com. I'm doing this from memory. The Buffett indicator, it's at an all-time high. Stocks have never been this expensive as measured by the Buffett indicator. It's over 200% now. There's something called the euphoria meter. Believe it or not, that exists. That's the highest it's ever been, at least in the data set I've seen, which goes back into the late 80s. We have never seen people this concentrated in this few stocks and this enthusiastic about it. And guys, extremes are called extremes for a reason. They don't last forever. They eventually revert. So if they revert, even just ends the party, let alone causes a major correction in the Magnificent Seven stocks, that's going to send shockwaves through every market around the world. And this is one of the things that I've been telling people in the spirit of today's video, looking into 2025. What do we see ahead? Markets are euphoric, as we've talked about, and not the only reason they're euphoric, but a reason for the recent spike in euphoria we've seen has been Trump winning the election and people saying, okay, he's going to have a bunch of really economically friendly policies to drive growth. Animal spirits have been running wild as a result of that. We have to understand that A, there are a lot of problems that he's inheriting. B, the economic policies that he's announced are pretty disruptive. They're not going to come without a price. There's a lot of dismantling. There's going to be a lot of, whether it's the threat of tariffs for other countries, whether it's going to be gutting federal bureaucracy, whether it's going to be deporting millions of people that are employed in this economy, whatever side of the legal immigration perspective you fall on. A fact is that a lot of these people work under the table for a lot of key industries in America. If Trump is actually successful in generating the long-term economic boom that he wants to create, and I hope he does create it successfully, there's going to be some hard medicine that we're going to be taking at the forefront of this. And that's something that I think the market is just not pricing in at all right now. So I do think there's probably a better than average potential for Trump's inauguration. Was it buy the rumor, sell the news type of moment where reality begins to sink in, that people say, okay, we're the dog, we caught the car, great. But there's actually going to be some pretty heavy lifting before we get the long-term results that we're hoping for. The central banks are going to find themselves having tougher sledding ahead. It's, hey, demand for our sovereign debt is weakening. Why is it weakening? Other central banks around the world are making the choice that rather than owning U.S. treasuries, we probably should own something else. And what is the something else they are turning to? It's gold. Yeah. And some of this is, don't listen to what they say, just watch what they do. If that's what the major central banks around the world are saying, that may be, if not the preferred asset to hold, at least one that is preferred versus treasuries on a relative basis right now, which used to be the safest asset in the world. Maybe we as individuals should have some exposure to that too. Commercial real estate, I don't think anybody needs me to tell them that commercial real estate's in a world of hurt right now. And I'm not an expert in that space. There may actually be some good values out there right now if you've got a decade plus long perspective, because there's definitely lots of properties out there that are playing on pennies for the dollar right now. But there's a lot of defaults that are going to happen in that space, have not even really begun to ripple through the system yet. And that's another thing that's going to weigh on the future as well, future stability. What will that do to the banking system as those debts get written written down and have to become realized. But on the residential housing market, that's another thing that I think is going to probably feel quite different in 2025 than it's felt in the past several years. We had mortgage rates increase at a dramatic rate over the past several years. Folks were holding on, thinking that the Fed was going to start cutting interest rates. That was going to bring mortgages down. Surprised it hasn't. In fact, mortgage rates are higher now than when the Fed started cutting interest rates. But the housing market itself, on average, at least nationally here in the US, prices haven't come down. It's not the sign, though, of a healthy market. It's basically a frozen market where transaction volume has dropped to the lowest in recent memory. And it's essentially the wealthy trading properties amongst each other. And so that's keeping average prices high. But as time goes on in the story, time is not the housing market's friend here. As mortgage rates continue to stay where they are and prices continue to stay where they are, first off, we've never had home prices be this unaffordable for as large of a percentage of aspiring buyers in America as they are right now. So we've got a record percentage of the population that's just priced out of owning a house. As time goes on, you start to have motivated sellers too, where people just, some percentage have to sell their house for some reason. They die, they get divorced, they get forced to move because of their job, they lose their job. America has a much higher percentage of fixed rate mortgages, but there are people out there that still have variable mortgages. And this is actually very relevant to every homeowner. The cost of home ownership has gone up. So even if your mortgage rate has been locked in, your insurance has gone up by a lot. Your cost of maintenance and repairs have gone up by a lot. Your property taxes have been assessed higher. If you're just making the same amount of money, but those costs are going up, you're getting squeezed more and more as time goes on. We've got that sort of lit fuse going on. Now, we also have had in the recent decade a much higher percentage of investors buying single family homes. These are, yes, mom and pop investors who got into real estate a little bit more aggressively than they had in the past, but it's also been people who caught the short-term rental boom during COVID. Everybody said, hey, I'm going to go buy Airbnb properties because everybody's doing revenge travel now that COVID's over, and I'm going to become a passive millionaire from all these rental properties that I'm scooping up. Then you had big players, the Blackstones of the world, coming in and just buying up thousands of houses, oftentimes within the same metro. So you got to understand, for those investors, owning the home is not a keeping a shelter over my head decision. It's simply an Excel decision. It's, hey, we thought this thing was going to return a certain amount of cash flow. It's not. So let's get rid of it. We're beginning to see that inventory begin to flood into certain markets, particularly those markets which were the most hot leading up to the recent years. These are what we call the sunshine states in America. It's where Airbnbs are the most plentiful. It's where the developers were building the most homes. So now we have the developers still bringing inventory onto these markets right at the worst time as they're beginning to soften for all the reasons I mentioned. Plus these investors beginning to dump their properties. Plus these just regular homeowners increasingly not able to afford the homes that they have over their heads. So the key thing here is inventory. It's been really tight up until recently. And now in an increasing number of markets, we're starting to see huge spikes in inventory. Now, in many cases, like in Texas and Florida and a lot of markets there, a lot of metros there, the inventory is now higher than it was pre-COVID, right? And the trajectory is still going higher from here. So that's like a contagion that is beginning to spread into more and more states. And so unless one of two things happens pretty dramatically in 2025, unless we see mortgage rates really come down pretty aggressively, which I don't see happening anytime soon on the radar, or in case, except local incomes start really skyrocketing, we're going to have some sort of reckoning in an increasing number of metros in America where the only way to get inventory moving is going to be lower prices. And it's going to be painful for a lot of homeowners, but it'll finally start providing some relief to aspiring home buyers who have been so frustrated in recent years that they just haven't been able to get into the homeownership game. I think it's very hard not to see AI as a long-term jobs killer. There's something that has been known forever in economic theory. Keynes referred to it as the issue of technological replacement, which is if technology can do a better job than human labor, you should replace the human labor with the technology. But you have to be very careful about the pace at which you replace the human labor. If you replace the human labor much faster than you're able to repurpose that human labor to additional constructive use, you end up creating a societal problem, the cost of which oftentimes is bigger than the gains of the technology. And I think that's one thing with AI, we're just running at it at breakneck pace. And I don't think we as a society have said, hey, if this ends up displacing millions of workers, what are we going to do about that. I don't doubt that there's going to be a lot of benefits coming from this most recent boom in AI. And I'm not an AI expert, but I've talked to enough that they really do want to say, hey, look, the type of AI that we're talking about, these large language models and whatnot, it's not true artificial intelligence. It's an evolution of the technology that we've had. It's not revolutionary the way that some people think of. And there are other forms of AI that are focused on that. I think what they've said is, look, euphoria around what AI is going to deliver, the current generation of AI is going to deliver, is highly unlikely to be met by the profit increases we're going to see in corporate America. We've spent hundreds and hundreds of billions in corporate America investing in AI right now. And to date, we haven't seen nearly that type of benefit at the bottom of the income statement. And now maybe over time we will, but a lot of the technologists compare this to the dot-com bubble in the sense that, hey, look, the internet actually did deliver eventually on expectations, and in some ways even more so than what we initially thought, but it took an awful lot longer than we expected. And so we had given our enthusiasm, we brought tomorrow's market value in, back by the end of 1999 into 2000, but then it took forever for that to really be fully realized in the market, which is why the NASDAQ corrected, and basically we had a lost decade in it. So I think that's one of the risks here, which is, do we have again a buy the rumor, sell the news type of event in the AI stocks where folks just say, hey, you know what, it's going to take a lot longer for the trillions and trillions in market cap that we've already given these AI companies over the past couple of years to come to fruition. And therefore, we need to bring down their multiples, or at least we need to hold these stock prices steady for a long time.